If you paid federal income taxes last year and you're 65 or older, there's a very good chance the IRS actually owes you money right now, and I'm not talking about a simple math mistake or your standard tax refund. This is about a brand new $6,000 deduction from the one big beautiful bill. It went into effect this year, but most seniors completely missed it. In this video, I'll break down exactly how it works, who qualifies, and the specific income limits you need to watch out for. More importantly, we'll cover the biggest mistakes that cause people to lose this money completely and how you can still claim it using Form 1040X if you've already filed your taxes for the year. To see how this new rule applies to you, let's look at the standard deduction first. For the 2026 tax year, the base standard deduction is $16,100 if you're single and $32,200 if you're married filing jointly. The new Enhanced Senior Deduction doesn't replace these numbers, it just stacks right on top of them. But here's the part that most people miss. You actually get to combine three different layers of deductions. First, you have your base standard deduction. Second, you have the traditional age 65 plus add-on, which under Internal Revenue Code, Section 63EF, is $2,050 for single filers and $1,650 per spouse for joint filers. And third, you get to stack the new Enhanced Senior Deduction on top of that, which is an extra $6,000 per eligible person. Let's look at the actual total amount of income you can legally protect from the IRS under this stacked structure. If you're single and 65 or older, you get $16,100 plus $2,050 plus the $6,000 enhanced break. That means $24,150 of your income is completely tax-free before the IRS even starts counting. If you're married and both of you are 65 or older, you get $32,200 plus $3,300 for your age add-ons, plus an extra $12,000 from the enhanced deduction. That shelters a massive $47,500 of your combined income from federal taxes. The qualification rules themselves are very simple. You just have to reach the age of 65 on or before December 31st of the tax year. It doesn't matter if you take the standard deduction or if you itemize your deductions on Schedule A. Either way, you can claim it, and this rule is locked in from tax year 2025 through 2028. But there's a catch you need to know. There's an income limit, and it's based on your modified adjusted gross income, or MAGI. If you file as a single person and your income goes over $75,000, the deduction starts to shrink. For married couples, that sliding scale begins at $150,000. If you're under those numbers, you get every single dollar. If you're above them, the deduction phases out gradually. For single filers, it reduces by $60 for every $1,000 you make over the $75,000 limit, meaning it phases out completely once you hit $175,000. For married couples, it phases out completely at $250,000. So even if you are above the starting line, you might still qualify for a partial deduction, and it's absolutely worth running the numbers. Let's look at 3 quick examples to see how this works in real life. First, look at Robert. He's 67 and single. He gets $22,000 a year from Social Security and makes $8,000 from a part-time job. His total adjusted gross income is $30,000. He's well under the $75,000 limit, so he gets the full $6,000 deduction in his 12% tax bracket That puts an extra $720 back in his pocket every single year. That's nearly $3,000 over the 4-year life of this law. Then we've got Barbara and Frank. Both are 70, and they file jointly. Between Social Security, Frank's small pension, and some investment dividends, they bring in $90,000 a year. That's under the 150,000 married threshold. Since both are over 65, they qualify for the full $12,000 joint deduction. At their tax rate, that saves them over $1,400 a year. Over 4 years, that's nearly $6,000 of real money saved. Finally, there's Patricia. She's 68 and a retired teacher. Her pension and personal investments bring her total income to $80,000. Since she's just over the $75,000 limit for single filers, her deduction will partially phase out. Because she is $5,000 over the limit, her deduction is reduced by $300, meaning she still gets to claim a massive $5,700 deduction. This is exactly why you shouldn't assume you get nothing just because you make a bit more money. Unfortunately, thousands of retirees are still going to miss out on this tax break because of a few simple mistakes. The first big issue is trusting your tax software too much. If you use TurboTax, H&R Block, or TaxSlayer, don't assume they handle this automatically. This deduction is brand new and software updates take time. Often, the system doesn't flag it for you, even if you entered your birth date correctly. You need to actively look for it. Go to the search bar inside your tax software, type in Enhanced Senior Deduction, and hit Enter. The software should then prompt you to generate the specific form needed to claim the credit. The second mistake happens when you work with a professional CPA or tax preparer. People often forget to remind them about their age, especially if a spouse just turned 65 during the tax year. Don't assume they looked closely at the birth dates on your file. CPAs are incredibly busy during tax season, and they use templates from previous years. Tell them explicitly that you are claiming the new $6,000 enhanced break. Also, don't confuse this new law with the old senior deduction. Before this law, you already had a smaller age add-on, which was around $1,500. This new $6,000 break is completely separate. You want to make sure your return is actively claiming both. If your tax professional tells you that you already got your senior deduction, make sure they didn't mix up the old Section 63F rule with the new One Big Beautiful Bill provision. Another misconception is thinking this only applies to retirement accounts like an IRA or 401k. It doesn't. It doesn't matter if your money comes from Social Security, a part-time job, rental properties, or investment dividends. The IRS only cares about your age and your overall income level, not where the check came from. And finally, please don't think it's too late. Just because you've already submitted your tax return, the IRS gives you a 3-year window to fix past mistakes using Form 1040X, which is the amended tax return. If you've already filed your taxes and missed this deduction, you can send in an amendment and get that money back. Let's walk through exactly how to do this, because it is much simpler than most people think. First, you or your tax professional will need to download Form 1040X from irs.gov. In column A of the form, you enter the numbers from your original return. In column C, you enter the corrected numbers, reflecting the new $6,000 senior deduction. But the most important part is part 3 of the form, which is the explanation of changes. In this section, you must write a clear, concise sentence. You can write exactly this: Amending return to claim the Enhanced Senior Deduction under Public Law 119-21 as taxpayer reached age 65 during the tax year. Once you submit Form 10-40-X, the IRS typically takes 16 to 20 weeks to process it. You can easily track the status of your refund online by going to irs.gov and using the tool called Where's My Amended Return? It takes about 3 weeks after mailing for the form to show up in their system, but once it's approved, they will mail you a physical check for the difference, plus interest. When you sit down with your tax professional this week, ask them this exact question. Are we claiming the new enhanced deduction for seniors under the One Big Beautiful Bill, separate from our standard age add-on? Since the rule is so new, you have to be your own advocate. Don't let your hard-earned money stay in a government account just because of a silent rule. To sum it all up, this is a massive tax break for anyone 65 and older, and it's available right now. Check your income limits this week. Talk to your tax preparer and look into Form 1040X if you need to fix an old return. If this breakdown helped you make sense of the new rules, please share this video with friends or family who could use the break. This is your hard-earned money, and there's no reason to leave it in the hands of the government. I'm George. Thanks for watching, and I'll see you in the next video.